You know, when it comes to trading, we're all obsessed with one thing: what to buy. But what if that's the wrong question? What if the real secret, the million-dollar difference, isn't what you own, but when you decide to trade it? Well, today we're diving into some pretty incredible research that's using quantum computers to crack that exact problem. So let's start with a number: 249. What's that? Well, that's the number of trading days in 2025. And for this experiment, that's our racetrack. It's the year where this new quantum strategy goes head-to-head with all the old-school methods. And that brings us to the big question, the puzzle at the heart of all of this. With 249 days to choose from, how many times should you actually rebalance your portfolio? I mean, think about it. If you trade too much, the fees will just eat you alive. But if you don't trade enough, you miss out on big moves and your portfolio gets way out of whack. It's this hidden leak that sinks so many investment strategies, and that's exactly what this research is trying to plug. All right, part one, picking the perfect team. So before we even get to the fancy quantum stuff, we've got to build a solid foundation. You need a good portfolio to start with, right? So step one is actually a really smart, classical approach to picking the right team of stocks. Okay, so how do they do it? Step one is all about diversification. The system digs through the S&P 500 looking for assets that don't all move in the same direction. You know, they don't all go up together and they don't all crash together. On a chart like this, what you want to see is a lot of that calm yellow color. That means low correlation. It's like building a sports team. You can't just have all strikers. You need some defenders, some midfielders. You need a mix. Then comes step two. Once you have these groups of players who don't overlap, the algorithm picks the MVP from each group. And how does it do that? It looks at something called the Sharpe ratio. Now, that's just a fancy way of saying how much bang are you getting for your buck? Or more accurately, how much return are you getting for the amount of risk you're taking? The higher the number, the better the player. So you end up with a team of all-stars, but they all play different, complementary positions. And there you have it. After that two-step classical process, we're left with a carefully selected 10-stock portfolio. It's diverse, it's packed with high performers, and now it's ready for the quantum challenge. Part 2, the quantum rebalancing puzzle. Okay, so we've got our portfolio. Now for the really cool part. This is where we take that when to trade problem and turn it into a massive, complex puzzle, the kind of puzzle that classical computers are just not very good at, but quantum computers are built for. The puzzle's technical name is a QUBO. That stands for Quadratic Unconstrained Binary Optimization. But forget the jargon. Think of it this way. Imagine you're a delivery driver with hundreds of packages. Every single choice you make, do I go to this house now or later, changes the optimal route for all the other houses. It's a web of interconnected yes or no decisions. And a QUBO is a way of framing that problem, so you can find the one single best route out of literally billions of possibilities all at once. So what are the ingredients for this particular puzzle? Well, it's all about balancing three things. First, there's a reward. If you make a trade on a day that's going to boost your returns, you get points. But then there are the penalties. You get dinged for transaction costs. Every trade costs money. And you get another penalty for trading too often. You know, making a trade on Monday and then another one on Tuesday is just inefficient. The quantum computer has to weigh all these rewards and penalties for every single day of the year. And this image? This is basically what the puzzle looks like to the quantum computer. Every blue square is a good day to trade, a day with a potential reward. Every red square is a bad day, a day where trading would cost you. The job of the quantum algorithm, in this case one called QAOA, is to find the perfect path through this landscape. It has to find the route that hits the most valuable blue squares while dodging the costly red ones. It's like a quantum oracle that can see all the possibilities at once to find the absolute best one. Part 3, classical versus quantum showdown. So, the stage is set. We have the classically built portfolio, and we have the quantum-powered trading schedule. So, how did it actually perform? Let's check out the results of the big showdown against 15 other, more traditional strategies. Okay, let's just start with the headline number because it's pretty wild. 44.5%. What is that? That's how much lower the transaction costs were for the quantum strategy compared to the very best classical strategy it was up against. I mean, think about that. It didn't just win, it won by being smarter and way more efficient. So let's look at that a little closer. The best of the classical bunch? It rebalanced 24 times throughout the year. The quantum-assisted strategy did it just 8 times, a third of the trades, less than half the cost, And, as we're about to see, it got even better results. It's the definition of working smarter, not harder. And yeah, about those better results, it wasn't just about saving a few bucks on V's. This is the Sharpe ratio again. Remember, higher is better. It measures your return versus your risk. And look at that. The quantum strategy comes out on top. It achieves the highest Sharpe ratio of all the strategies they tested. So it wasn't just making more money. It was making more money by taking smarter, more calculated risks. And really, this chart of the cumulative returns just says it all, doesn't it? That bright orange line, that's our quantum strategy. It ends up right at the top of the pack. The bottom line is simple. Fewer trades, way lower costs, and a better final return. It's a clean sweep. Part 4. What is quantum advantage? So, okay, this is a really cool result for a trading algorithm. But what does it mean for the rest of us? What's the bigger picture here? Well, these results aren't just about finance. They're pointing towards something really important in computing called quantum advantage. And this is key. This wasn't some lucky fluke. Take a look at this chart. It shows where the quantum algorithm's answers landed, and you can see it wasn't just guessing randomly. It consistently found the absolute best or very close to the best schedules over and over again. The results are all bunched up around the optimal solution. This thing was genuinely solving the puzzle. How much better was it? Well, the algorithm made finding that perfect trading schedule 18 times more likely than if you were just randomly trying different combinations. It was actively hunting down and zeroing in on the right answer. That's something classical computers really have a hard time with on problems this complex. And that, right there, is what experts mean when they talk about quantum advantage. It's the trifecta. You're solving a real-world problem that has actual commercial value. You're outperforming the best classical computers and algorithms we have. And you're showing that there's a real path forward to solving problems that are, for all practical purposes, impossible for today's computers to even attempt. What this research really shows is that we're right on the edge of a completely new era, not just in finance, but in all kinds of complex optimization. Which, of course, leaves us with one last, pretty mind-bending question to think about. Is your next financial advisor going to be a quantum computer? Looking at results like these, the answer might just be yes, and maybe a lot sooner than any of us thought.